The Learning Spire. Maximize your retention with short and clear lectures assisted by binaural tones. Today, we will be getting into the double entry rules of accounting. The double entry rules provide that every transaction causes an equal and opposite effect on two or more accounts. This is because the accounting equation calls for a balance between assets and liabilities plus owner's equity. A link will be provided in the description to a video taking a more in-depth look at the accounting equation. Now, let's work through 5 common transactions that require adherence to the double entry system. Example 1. The owners invest $9,000 into the business. This transaction results in a debit of $9,000 to cash, and it also results in a credit of $9,000 to common stock. We must debit cash because to increase an asset like cash, we have to debit it. The reason why we need to credit common stock is because it is on the right side of the equation and is therefore increased by credits. Example number 2. A company buys $8,000 in office supplies on account. This transaction results in a debit to supplies for $8,000. Supplies are debited in order to increase them because they are an asset account. This transaction also results in a credit to accounts payable. Since accounts payable are a liability account, they are increased with credits. In this particular example, there is no reason to expense any of the supplies since they have not been used. We simply record them at the cost that we were able to buy them for. Example number 3. The company purchased equipment for $5,000. This particular transaction affects only one side of the equation, the asset side. Equipment and cash are both assets. However, in this particular equation, cash is being decreased. In order to decrease cash, we must credit it by $5,000. In order to increase the equipment account, we must debit it by $5,000. The duality of the double entry system still exists even when only one side of the equation is being affected. Example number 4. Rendered services for $6,000 cash. In this transaction, the cash account must be increased by debiting it for $6,000. The sales revenue account must be credited for $6,000. Sales revenue increases the owner equity account. Since sales revenue is funneled into the owner equity account, it is on the right-hand side of the equation and must be increased with a credit. Example number 5. The company paid for office supplies purchased on account for $8,000. In this particular example, we are both decreasing cash and decreasing accounts payable. We are using cash, $8,000, to pay accounts payable of $8,000. Therefore, we must credit cash for $8,000 and debit accounts payable for $8,000. That concludes this concept. Thank you so much for joining the Learning Spire.